Hello and welcome to this video on over leveraging in trading. Over leveraging refers to using of high amount of leverage or borrowing in order to amplify the potential returns on a trade. While leverage can be a useful tool for traders, it can also increase risk and lead to significant losses if the trade does not go as expected. One real life example of over leveraging in trading occurred during the global financial crisis in 2008. Prior to the crisis, many financial institutions and investors used leverage to amplify their returns on mortgage backed securities, which were considered to be low risk investments. However, as the housing market began to decline, the value of these securities fell, leading to significant losses for many firms and investors. For example, Lehman Brothers, a major investment bank, had a leverage ratio of over 30:1 at the time of its bankruptcy in 2008. This high level of leverage meant that the firm was highly reliant on its performance of its assets and had little margin for error. When the value of its assets began to decline, the firm was unable to meet its margin requirements and was forced to declare bankruptcy, leading to cascading series of events that contributed to the global financial crisis. So, this example illustrates the potential risks of over-leveraging in trading, as the high level of leverage used by Lehman Brothers amplified the potential losses and contributed to firm's downfall. It also demonstrates the importance of carefully considering the risks and rewards of using leverage and managing risk appropriately. Another example of over leveraging in trading occurred during the dot com bubble in the late 1990s. During this period, many investors and companies used leverage to amplify their returns on technology stocks, which was considered to be high growth investments. However, as the bubble began to burst, the value of these stocks fell significantly, leading to significant losses for many firms and investors. For example, long term capital management was a hedge fund that used leverage to amplify its returns on variety of investments, including technology stocks. At its peak, the fund had a leverage ratio of over 100:1, meaning that it had borrowed more than 100 times the value of its assets. When the value of its assets began to decline, the fund was unable to meet its margin requirements and was forced to liquidate its position, leading to significant losses for its investors. This example illustrates the potential risks of over leveraging in trading, as the high level of leverage used by LTCM amplified the potential losses and contributed to the fund's demise. It also demonstrates the importance of carefully considering the risks and rewards of using leverage and managing risk appropriately. One of the main risks of over leveraging is the potential for large losses. Leverage amplifies both potential profits and potential losses. So, if the trade goes against you, the losses can be much larger than if you had not used leverage. This can lead to financial losses and even the potential for margin call, where the broker demands that you deposit additional funds to cover the losses. In addition to increased risk, over leveraging can also increase the volatility of a trade. This can make it more difficult to manage and potentially lead to large losses. For example, if you use volatility to trade a volatile asset such as cryptocurrency, the price may fluctuate significantly, which can lead to rapid change in value of your position. Trading with leverage also often requires you to maintain a minimum level of equity in your account, known as the margin requirement. If the value of your position falls below the margin requirement, you may be required to deposit additional funds to close out the trade to avoid a margin call. Despite these risks, leverage can also be a powerful tool for traders. It can be used to amplify potential profits and can be a useful tool for maximizing returns on a trade. However, it is important to use leverage sparingly and to have a solid understanding of underlying assets and market conditions before using it. To manage risk when using leverage in trading, it is important to select appropriate leverage levels, set stop loss orders, and diversify your portfolio. By being aware of the potential risk and rewards of over leveraging and taking steps to manage risk, you can make informed decisions about your trades and increase your chances of success. Thank you for watching this video on over leveraging in trading. For more information, be sure to subscribe to our channel for more helpful tips and strategies.